to another edition of the Heritage Wealth Planning YouTube channel, my friends. Today is going to be the second part of my two-part series on indexed annuities. The last video I just did a few hours ago talked about how the accumulation component of the annuity, how much money you can actually, and the growth of it. And as I said there, that left a lot to be desired. And this one will too, actually. This could be about the income you can receive from the annuity. So two parts. One is the growth prospect. The other is the income prospect. Both leave a lot for me. Both leave a lot to be desired for me personally. I'm sure there are cases where they work. In this case, with my friend whose client has a large TSP who's considering rolling it over to an index annuity, I don't see the value here. So let's dive right into it. All right, so here is our annuity, the brochure of the annuity. It's 20 pages all told. The brochure is I mean, Frank, I actually give them a lot of credit, these guys, American National Insurance Company, because if you actually dive into the brochure, you can tell for yourself that it's not overly optimistic, let's put it that way. And if it's like that in the brochure, well, I mean, I tell you, good for them to make it legitimate. I think some of these programs that you see or read about, man, they're shooting for the moon, and they're not going to get it. I don't find that the case here. I think these guys are telling it like it is. And I do think there are potentially some benefits for some people. For most, if not the vast majority, I don't see that. So let's just skip into it. We're going to move down here. We talked about essentially the reason why the annuity sells, because index annuities are selling like hotcakes, is my understanding. I don't do any of these things. I don't sell any annuities. Fixed annuities don't sell. Variable annuities have taken on the chin. They don't sell very much. And so the other option are now, they rolled these out about 20 years or so ago. Index annuities, they lop off this bottom. The downside, there's no downside risk to you, and instead you only capture some of the upside. But like I talked about in the last video, you're not really capturing much of the upside. If you're going to lop off the bottom to avoid these 4 years, and this is 2000, 2001, 2002, and 2008, you're also lopping off a lot of the top. And because you avoid these 4 years, you're going to be avoiding these, 12 years or so. And that's too bad. That's where the annuity hurts in terms of the accumulation, how much money how much your account can actually grow to. So let's talk about the income, though. We're just going to dive right into this here. Talk about the surrender charge. Okay. So here is a lifetime income rider. All these things are for a fee. They give you a couple options here. A fixed rate set at issue and a guaranteed for a life of the contract is compounded daily for a set number of years. For example, if your fixed rate is 7.2% for 10 years and your income base will be credited 7.2% each contract year for 10 years. That just means it'll double. Your income base will double. I'll talk about that more here in just a second. A fixed rate at issue and guaranteed for the life of contract is compounded daily for a set number of years, plus the portion of your premium allocated to index crediting strategies will earn interest upon any increase in the index. Interest credit will be earned until you begin to see withdraw income. So, for example, if your fixed rate is 4.2% for 10 years, your income base will be credited by 4.2% each year for 10. Plus, you're going to earn some extra earnings too until you start drawing on income. So we'll use these two examples that they share with us, which is pretty interesting. Let me make this a little bit bigger. So for any annuity, I don't care what it is, any annuity, you have two options. You have single life just on you, and then you have joint life just on you and typically your spouse. So let's just say, and the example I'm going to show you is a 69-year-old person. In this case, it's unisex, man or woman. They're going to give you 5.4% of benefit base on an annual basis. So if you have a benefit base of 100,000, you're going to get 5,400 a year until you die. Now take that same person, but they're now married. That same 69-year-old married couple, their benefit base is 100,000, but instead of getting 5.4, they're only getting 4.9. So they're going to receive $4,900 a year as opposed to $5,400. And the reason for that is simply there's two lives the insurance company needs to cover. Most likely, the woman will survive the man, but someone's going to live longer than the case in single life. And so because of that, The insurance company's got to give you less on the front end to make sure that they don't go out of business. Does that make sense? I mean, it just makes sense. You got covered more risk the insurance charges. There's a separate premium charge for each lifetime income rider option, which is locked in at the beginning of the contract. Ask your current agent for the charges. Well, that's I think they share with us what these charges are, but you still have to ask. All right, so hypothetical one, we're getting value of 100,000. The index return from 1998 until 10 years, which I'll show you in just a second. No income rider premium enhancement, so you're not adding charges because you haven't added an enhancement to your income. And owner's age when they drop to $100,000 is 58, which means they'll be 69 when they start pulling money out. And after I talked about last video, there's 4 different strategies of income. They put 25% in each of these 4 buckets. And we know after 20 years, as a matter of fact, in the last episode, $100,000 in these 4 buckets grew all the way to $155,000. Not a significant rate of return, 2.2%. In this case, they use a 7.2% fixed rate, 10-year income base, and a 0.9% rider. Right there, the 0.9% rider premium is assumed, and that's not cheap. And so after the end of 10 years, their annuity value, because they're going back to this right here, these are calculating for a growth of the has grown to $112,000. Folks, that is what's called your walkaway money. If you call the annuity company and says, send me a check because I want to go buy a boat or buy land or something like that, this is the amount of money they're going to cut you. They are not going to cut you a check for this. This is your income base. So you start with $100,000. It grows each for 7.2%, which means it'll double in 10 years to $200,000. Your income base is just the amount that you can receive as an annual income. You cannot the one-time walkout, or what I call walkaway money, what the business call walkaway money. So you have 2 options. You can say, cut me a check for $112,000. It's free and clear of any surrender charge at that point. Or you can say, send me an income based on this income base. And we already calculated that because you're 69 years old, this will be 5.4% a year for the rest of your life. So that's $10,800 every year for the rest of your life. So what happens is you can see the contract amount, your walkaway money goes down to $4,700 because you're taking a lot more money than your account is growing. And you can see it's being reduced by $10,000, $11,000 each and every year. Essentially, you're going to run out of money in year 10. Now, you still have an income benefit of $10,823. That won't go away. But the problem is that's not adjusted for inflation. And so what that means is this amount of money is not going to buy the same amount of that amount of money in 10 years because of inflation. Inflation erodes your purchasing power. So not only are you running out of money from a cash value perspective, you're running out of money from a purchasing power perspective as well. You basically gobbled up all your money. Before I forget, remember that 5.4% amount, that is also not, that's a return of principal plus interest, by the way. Just got to be clear there. That's return of principal plus interest, okay? So that means you're not getting that like an interest. You're getting a portion of your money back plus a little bit of interest. I just want to be very clear there. When people say they're getting 5.4% on an income base, I said, well, you can't compare that to a bond because it's literally getting money back, and they're using that as a percentage of how much you can get. So let's use the hypothetical example number 2. Same for accumulation products here. For 100,000 goes in, 25,000 goes in each. In this case, they're getting a 4.2 fixed rate because they're going to get some more crediting on their money as opposed to the benefit we just talked about. They're going to get a less of an income-based growth, but more of an accumulation growth. Does that make sense? So they're sacrificing potential for income for potential for accumulation, and unfortunately, in this case, their index, their cash value, the walkaway account is $118,000. So it's about $6,000 more than what it was in the other example we just used. And instead of having $200,000 as an income base, they have $191,000. Now 5.4% off this 191,000, and it's going to give them $10,300 a year for the rest of their life. Go to fast forward to year 20. Well, here they have $20,000 left, where the account had less than 5,000. But again, they're only making 10,300, where they're making 10,800. So they're basically 10,300 over $500 left. The other account for 10 years, that's basically 5,000, 6,000, 5,000. Like here they got 14,000 more. So it's somewhat of a wash there. Either way, $10,000 today is not going to purchase the same $10,000 in 10 years. It's just the cost of inflation. It erodes your purchasing power. And I have a video on that, which I'll link to right now, about inflation. Even low inflation environments can really destroy your purchasing power. And this is only 10 years. If they let these guys go for 20 more years, this would certainly be gone. Yeah, they still get 10,318. It's not going to buy about 60% of what it could buy today. And so it's every year, both accounts are dropping. The amount of money, your purchasing power is declining because of inflation, and your walkaway account is declining because you're taking too much money out. Now remember, you're like 79 years old here. You've got $20,000 left in the account. Yeah, you're getting $10,000 a year, but that's just not that favorable. Now, lastly, and we'll close this up. When I ran a calculation, which I won't show you here, on using this plain vanilla mutual fund, I said, excuse me, 98 right here. So they put $100,000 in a plain vanilla mutual fund with a 3.5% front end commission, and this is factual actually. Their account today would be worth $450,000. $450,000. So 3 times the amount of what this annuity would be worth. And that just means you have more income. It just means you have more income. It'd be worth about $270,000 after, which again just meant if you're taking 5% a year off of $200,000, 5% a year off of $300,000, or 5% a year off $400,000, you have more income, and the income increases because with inflation and as the cash grows in your account, you can take more off it. Now, this does not mean you should buy mutual funds that are aggressive, because you can lose money. I mean, the facts are mutual funds lost 40 to 50% of their account value in 2007 to 2009. They lost 40% of their account value from 2001 and 2000. At least this annuity did not. But the drawback is if you have other sources of income, like these government employees with a TSP, with FERS and CSRS, or a military pension, a government pension, you probably have your income streams covered with your Social Security and or government pensions. And don't forget, just because you're on a government pension does not mean you're not going to get Social Security. There are fewer and fewer people being subject to the government pension offset or the windfall elimination provision, which I won't talk about here, but I will post another video on those two. But if you've been paying Social Security tax, you will get your full Social Security benefit. There's just no. Now, if you haven't been paying Social Security tax, you won't. But if you've been paying your Social Security tax, and I guarantee you that general in the Army he will get his full Social Security benefit. So if he has a military pension plus a Social Security benefit, in this kind of product with significant surrender charges, only get a growth of $155,000 after 20 years, or an income stream of $10,000 after 10. I just don't see it, folks. I don't. I mean, again, by all means, if you see things differently, by all means, sure. And if you're an insurance guy who lives and dies by these, man, convince. I just today, and I did this analysis. As I don't see it. If you bought it, doesn't mean I don't with it, do what you got to do. But I'm willing to be convinced, but I just don't see it. So don't forget to subscribe. Don't forget to hit the notification button as well, that little bell, so you can be notified on future content. And if you have an issue with what I'm saying here, or just comments in there below, because I would like to see what the other side of this. I try to go into things with an open mind, but at least in this one case, I just don't see it. Hey, look forward to seeing you again on the next issue or next video of the Heritage Wealth Planning YouTube channel. Thanks, guys.